Yes, so on the risk management side, first of all, the fund has no leverage. Futures on Bitcoin, they are quite unusual, and our prime brokers require us to post 100% margin when we trade these futures. So by definition, we cannot have leverage. We pay full cash for whatever notional exposure we have in the fund. Moreover, we have some additional internal restrictions on the usage of cash. Our maximum long exposure is 2/3 of the account's size, cash or equity, and our maximum short exposure is only 50% of fund's equity. So no leverage, number one. Number two, every time we establish a position, we have a trailing stop attached to it. The way it works is, let's say we have a long position and we have a trailing stop, let's say 6% away from the entry price. If prices are immediately moving down after we enter the long position, the maximum that we can lose is 6% on that trade. However, if prices are fluctuating and let's say market is moving higher in our favor, the trailing stop would be moving higher as well because it's attached to the latest high price. And the goal, the idea of the strategy is that at some point, the trailing stop moves above the entry price. And then from that point on, it's just a matter of how much money we're going to make, a little bit or a lot. On the upside, we actually do not limit ourselves. So if the Bitcoin, quadruples in price in a straight line, we will participate in all those gains. We have no limit on the upside. The other risk management tools that we use, if we are in a drawdown of about 15 to 20%, we will deleverage risk overall. We will trade much less exposure. I already mentioned a little bit about the operational risks. We believe that one of the main advantages of trading futures is that we have virtually no operational risks. So from that standpoint, any risk manager that looks at our fund should be, happy and satisfied.